Hello everyone, and welcome. I'm excited to kick off today's presentation on a very interesting topic. Today, we'll be exploring the best bank shares in India for value investors, focusing on both public and private sector banks. The main highlight is looking at low PE ratios in 2026, which can signal some great investment opportunities. Over the next few slides, we'll cover key insights, what makes these banks attractive, and how you can identify the best value picks. So, let's get started and dive into the world of Indian banking. Let's start by looking at the public sector banks. Banks like PNB, Bank of Baroda, Canara Bank, Indian Bank, and Bank of India are currently trading at lower price-to-earnings ratios. This often indicates that they might be undervalued, making them quite attractive for value investors who are looking for solid opportunities at a reasonable price. On the other hand, private sector banks such as ICICI Bank, HDFC Bank, and Kotak Mahindra Bank tend to have moderate PE ratios. This suggests they are balancing growth potential with their current valuation, which can be appealing for investors seeking a mix of stability and growth. Overall, understanding these valuation differences helps us identify where the opportunities might lie, depending on our investment goals, whether we're looking for value or a blend of growth and valuation. Let's take a closer look at some of the best bank shares in India with low PE ratios as of 2026, starting with Punjab National Bank, or PNB, which is a public sector undertaking, or PSU. Its current price is around 122.9 INR, and the PE ratio is approximately between 12 and 15. The key takeaway here is that PNB offers an attractive valuation, especially considering its improving fundamentals, making it a potential value pick. Next, we have Bank of Baroda, also a PSU, trading at about 300.65 INR. Its PE ratio is roughly between 12 and 14. The outlook for BOBI is quite strong, backed by government support and a robust growth trajectory, which adds confidence for investors. Moving on to Canara Bank, another PSU, with a current price around 150.54 INR and a PE ratio between 10 and 12. It stands out for its low PE and stable retail expansion, suggesting steady growth prospects. Indian Bank is also noteworthy, trading at about 832.9 INR with an estimated PE of 11 to 13. Its strategy focuses on conservative risk management, which makes it undervalued and appealing for cautious investors. Then there's Bank of India, or BOI, priced around 146.02 INR with a PE ratio of roughly 11 to 12. Its improving NPA situation makes it a value pick worth considering. Shifting to private sector banks, ICICI Bank is trading at approximately 1,404.3 INR with a PE of around 19. It strikes a good balance between growth and valuation, making it a reliable choice. HDFC Bank, one of the most trusted names, is priced above 1,600 INR with a PE ratio near 20. It's considered a safe long-term bet, offering moderate valuation with consistent performance. Finally, Kotak Mahindra Bank is at about 2,126.8 INR, with a PE ratio around 22. While slightly higher, its strong fundamentals justify the premium, and it remains an attractive option for investors seeking quality. Overall, these stocks present a mix of value and stability, especially with their low PE ratios, which can be indicative of undervaluation or good growth potential. This aligns well with our theme of identifying promising investment opportunities in the banking sector. Let's take a closer look at the valuation landscape for banks. PSU banks like PNB, BOBI, Canara, Indian Bank, and BOI are currently trading at lower PE ratios. This often suggests they might be undervalued and could present opportunities for value investors. However, it's important to remember that a low PE ratio alone doesn't automatically mean the stock is a buy. Switching gears to private banks such as ICICI, HDFC, and Kotak, these typically have moderate PE ratios, higher than PSUs but still reasonable. When comparing them to peers like Axis Bank or Yes Bank, you can see there's a spectrum of valuation levels across the sector. But here, the key point. A low PE ratio shouldn't be the sole reason to invest. We need to dig deeper into factors like earnings growth, non-performing assets or NPAs, and the capital adequacy of these banks. These elements help us understand whether the valuation is justified or if there are underlying risks. So, in summary, valuation is just one piece of the puzzle. We have to look at the broader financial health and growth prospects before making any investment decisions. Let's talk about some of the risks involved in the banking sector. First, PSU banks, or public sector undertaking banks, often face higher risks related to non-performing assets, or NPAs. This means they tend to have more bad loans, which can impact their financial health. Additionally, PSU banks tend to adopt digital technology more slowly, which can put them at a disadvantage in a rapidly evolving financial landscape. On the other hand, private banks are generally considered safer investments because they typically have better asset quality and more efficient operations. However, they might not be as undervalued as PSU banks, meaning their stocks may already reflect their true worth, leaving less room for significant gains. Finally, we need to keep in mind that the market is quite volatile, and regulatory changes can come unexpectedly. These shifts can quickly impact bank valuations, making it essential for investors to stay vigilant and understand that these factors can influence the value of their investments in the banking sector. So, for value investors who are on the lookout for low PE opportunities, there are some interesting options to consider. On the public sector side, names like PNB, Bank of Baroda, Canara Bank, Indian Bank, and Bank of India stand out. These banks often trade at attractive valuations, making them compelling picks for those seeking value. On the private banking front, ICICI Bank and HDFC Bank are also worth noting. They combine the potential for value with a solid growth outlook, which is quite appealing for investors who want the best of both worlds. Overall, these banks offer a nice blend of value and growth potential, fitting well into a strategy focused on undervalued opportunities. To tie everything together, remember that these options reflect the broader theme of balancing risk and reward, and identifying opportunities where the market may have overlooked value.